Ireda in focus on the back of numbers. What we're going to try to do today is try to look at the bull case and the bear case on Ireda. Of course, the stock running away in trade, but always interesting to look at the bear case as well. So let's pull up, firstly, in terms of growth, it's been extremely strong, right? It's a fast growing sector, large tailwind with regard to where renewables is concerned, and they've grown their book at 27% CAGR. That, if I were to tell you, coming from a PSU, is of course indeed very, very strong. But what's the bear case here? It's the assets are chunky, they're large assets, and therefore any small slips, and we've seen this in power financiers, any small slips can cause a lot of pain. The other one is that Ireda comes off a very, very low base as well. So that 27% growth rate is on an extremely low base. In fact, a couple of years back, they were 1/10 the size of PFC, REC. They continue to be roughly a 7th in terms of the size, relative size versus PFC and REC. And therefore, quite in that sense, the growth to be put in perspective. Let's talk about margins. That's the other key piece which is driving profitability higher. Margins have gone from sub 2.9% only in this year, in this financial year, to 3.3% nearly. It's a 42 bip margin expansion, but the margin expansion has come on the back of a lower cost of funds and not higher yields. How sustainable is that? Your cost of funds coming off even more is always difficult, as there is always a bottom in terms of how much can cost of funds come down, and therefore NIM upside from here, I'm not so sure whether that may be doable or not. We spoke with management as well. Unlikely that that will sustain. So some bit of that profit headwind may just go away. And the third piece is with regard to the way in which profitability has evolved. You've seen a strong surge in terms of profits. 2 years, 40% CAGR profit, 27% CAGR loan book, 40% profit, margins aiding profitability. But there is one account, Gensol, which constitutes around 600 crore odd in terms of size, 650 crore, which might be slipping or might impact that profit compounding in this particular year. Maybe. We'll have to wait and watch for that. But that's the risk that the company faces, chunky assets, therefore. Last off, on valuations, stocks fallen 42% from peak levels, so clearly it's well off the highs, but still trades at 5 times price to book, which is certainly not cheap. Forget for a typical NBFC, but even more so in case of a power financier PSU, and therefore something to be kept in mind. Lancelot, which side of the fence do you sit on, if I can ask you? Would you sit on the bullish side where Ireda is concerned, or the bear?
Well, I am on the bearish side at the moment.
Okay.
And the reason behind that is, one is when you are financing only a particular sector, there is always this high risk that whenever that sector slows down or growth in the sector slows down, you will tend to see, higher proportion of NPAs, and then it becomes very difficult for the companies which are only financing a particular sector. And we've seen it in the past, whether it was tourism as a sector or it was power as a sector, and you had specialized financing, companies only for that sector. And there are periods of time when the sector undergoes, a bit of stress, and that could lead to, severe problems. The second issue with Ireda is that it is focused on a sector that at the moment, people are expanding at a very hectic pace. And because of the, the government's support as well as the thrust on that sector. But most of this financing takes place, for a long period of time, maybe 3 years, 5 years, 7 years. And over a period of time, conditions change, people's, activities change, and that could all have a negative impact on the sector. So that's why I would rather stay away from the sector at this point in time.
And would that view be the same for a PFC REC as well, given the fact that they're all within the power financing basket, but valuations are starkly different? So therefore, wanting your view there as well.
So I think as far as PFC, REC are concerned, it is while they do finance power, but they are financing various segments of the power sector. So you can have power generators, you can have people who are in the distribution line, the power transmission line, the power equipment manufacturers. So they are catering to various clients across different kinds of, although it is at the same broad generic power sector, so all people do not, let's say, get into trouble at the same point in time. Maybe the manufacturers or the power distributors, they may benefit at some point in time. The other people could have a tougher time. The actual users of power could have difficult conditions. So it sort of evens out. So I would still say, and even the valuations are a lot more favorable for both PFC as well as REC as compared to Ireda. So from that perspective, also these two could be still more, let's say, beneficial in terms of looking at it from a investment perspective, whether to add, it would be better to look at PFC, REC as opposed to only Ireda.